Firstly, the operating environment that most businesses are facing in 2011, 2012 is far different than what they were facing in 2007, say. Therefore, investments that were made 4 or 5 years ago were probably predicated on a set of assumptions about the future that have turned out in hindsight to be quite wrong. That's creating a series of adjustment processes within companies that owners of those businesses, especially private equity firms, in relatively highly leveraged situations have to get accustomed to dealing with. The second major challenge is probably that on a look-forward basis, what is becoming crystal clear now is that the only consistent driver of returns will be sustained and consistent operating improvement. The days of high amounts of cheaply available leverage have disappeared for the foreseeable future. From an Australian private equity perspective, the good news is that the overall operating environment and investment environment we face is quite positive. The economy is strong, government debt's low, unemployment's low, and so it's possible to find non-distressed situations out there where the outlook is relatively positive, and that's not the case in other parts of the world. Furthermore, I'd say the one thing that has remained relatively stable in the Australian private equity context has been the availability of funds and the identity of the various fund managers that make up the industry. So we haven't got the situation that you see in other parts of the world where you have too many fund managers with too much capital chasing too few deals, driving prices back up. There is a trend there that we'd expect to continue, but it's a trend that's been around for a while. Fundamentally, a strong Australian consumer products business that has a strong manufacturing and production base, a strong new product development capability and strong consumer franchise and understanding of consumers is a valuable proposition for a strategic buyer to take those assets and expand them through distribution channels in a highly synergistic way, especially in rapidly growing markets like Asia. Not specifically so. I mean, I think the overriding asset selection criteria is finding a fundamentally strong business that has the capacity for significant financial and operating performance improvement. In the Australian context, our experience would show that roughly half of the cases that we've invested in over the 14 or 15 years we've been going now have been situations where part of the growth opportunity is to expand the business outside of Australia, and that by its nature makes the business more attractive at exit to strategic acquirers. But I think you've got to start with the premise that Australia is of a meaningful enough scale that a fundamentally sound business that can grow well in this context will be attractive to the right buyer at the right time. When I think of roll-up, I think of aggregating a number of very similar businesses in a highly fragmented market, where the underlying investment logic is that you're buying these businesses at a multiple lower than what the combined scale of the business will be down the track, and where you can integrate the businesses and achieve some operating synergies. And there's been a number of studies that I've seen over the years that have consistently demonstrated that as an investment strategy, that generally doesn't work. People end up paying too much for each of the individual acquisitions. The hard work of actually integrating them doesn't get done, and as a result the synergies don't flow. I think what we've seen in some of our investments, such as Extralis and such as Link Group, is the ability to take a core, very strong business as a platform and then to expand that business through acquisition into adjacent product segments or geographies or both, and achieve high degrees of synergy by doing that. And I think that as an investment strategy is something that goes to the heart of private equity.